and long-term notes. So what we're going to focus on in these videos is really the calculations and the journal entries that have to be reported as it relates to bonds and long-term notes. The SmartBook modules and the textbook materials and the rest of the PowerPoint slides can be used to get an understanding of terminology and that kind of thing. These videos are really going to focus more on calculations and on essentially how we have to make the journal entries for these different types of transactions that relate to bonds and long-term notes. So when we talk about long-term liabilities in general, what we have to be aware of is the fact that because these long-term liabilities represent cash outflows for a business out into the future, when we go to record those on our accounting records in the current period, we have to be aware of the fact that those future cash flows are not the same as what they would be worth in today's dollars. So as we discussed in the Chapter 5 recordings or lectures, what we have to do in these situations where we have these long-term liabilities is we have to go through the process of calculating the present value of those future cash flows. When we talk about bonds and long-term notes, there are actually going to be two different cash flows that we have to be aware of. So the face amount, which can also be called the principal, the par value, the stated amount, that is the amount that is due at the end of the maturity period. So what is the amount that the issuing company that's issuing these bonds, what are they promising at the end of the period? That's the face amount. And is the first cash flow that we have to be aware of. Then the second cash flow that we have to be aware of is the periodic interest payment, also called the nominal interest, coupon rate, stated rate. Those terms are used interchangeably. But essentially what we have to do is account for on a periodic basis, depending on the terms of the bond, we are going to have to account for a future cash flow that relates to periodic interest as well. So when we think about these bond problems, what we're going to, again, rely on is what we learned in the Chapter 5 lecture about the present value calculation. So we have these future cash flows, and we have to figure out what they're worth in today's dollars. We have to do a present value calculation. So when we're thinking about bonds, there's going to be a series of essential pieces of information that we need in order to do these types of calculations and to figure out what the appropriate journal entries are. First, I'll say that sort of the unknown, the thing that we're going to be solving for in all of these cases is going to be the present value. So that's going to be our unknown. So when we look at the calculations that we have to do, we're going to be solving for the present value. So we're going to be using the equals PV formula as we did in the Chapter 5 lecture. And then also, again, the necessary inputs that we need for these types of problems. The two cash flows that we mentioned down here, the face amount, the amount that's due at the end of the period, is going to be our future value. So that's the face amount of the bond. The payment, PMT, that's going to be the periodic interest payment. And that's going to be based on the stated rate of interest. We're going to be asked for a number of periods, NPER, and that's going to be not necessarily just the number of years that the bond is outstanding, but it's going to have to be the number of compounding periods. So really, how many times is interest being paid throughout the maturity period? So NPER is going to be our compounding periods, and usually it's going to be either annual or it's usually going to be once per year, or we would have to say, okay, if it's semi-annual and say we have a 5-year bond, then it would have to be 5 times the 5 times 2, which is the number of times it's compounding per year. So in that case, the NPER would be 10. So you'll see how we kind of walk through that in a number of these examples. So future value payment, number of periods, they're going to be asking us for a rate, and that in these instances is going to be the market rate of interest. And we'll explain how the market rate and the stated rate is oftentimes going to be different when it comes to these bonds. We'll explain how that occurs and what effect that has on the calculation here in a little bit. So the rate that they ask us for in the calculation is going to be the market rate, and then they're going to ask us for, a type. And the type is going to be related to, it's going to be either 0 or 1, if you remember from the Chapter 5 lectures, and that's related to when the interest payments are made. So if the interest payments are made at the end of every period, then that's going to be an ordinary annuity, and we're going to use a type of 0. If the interest payments are made at the beginning of each period, that's going to be an annuity due, and our type is going to be 1. So each time in these examples, we're going to be solving for the present value. And what we're going to have to do is use the inputs given to us in the problem: future value payment, number of periods, rate, and type. And we're going to have to use those inputs to calculate the present value. Because again, if I go back to my previous slide, again, generally accepted accounting principles tell us that when you have a long-term liability, and that's going to result in future outflows of cash, those future outflows of cash need to be brought back to today's dollars. They need to be brought back to the present value, and that is what needs to be accounted for in your accounting records in the current period. So we're going to solve for the present value using these inputs in each of the given examples that we kind of walk through in our example. One other thing to keep in mind, I talked about the number of compounding periods and how that's not necessarily just going to be the number of years. That's also going to have to be, we have to take into account how many times per year interest is paid. That is also going to have effect on our PMT and on our rate. So when we have a bond or a long-term note that has, say, semi-annual interest payments required, when it comes to the number of compounding periods, we said that we would take those compounding periods and we would multiply them by how many times per year do we have to pay interest. So in the case of semi-annual, it would be multiplied by 2. When it comes to the interest, right, either the payment or the market rate of interest that we're given in the problem, what we are instead going to have to do is take that interest and divide it by the number of periods or the number of times per year that the interest is paid. And the reason for that is because each time we're given an interest rate, that interest rate is an annual interest rate. So if we are only making a payment for 6 months worth of interest, we have to take that annual interest rate, divide it by 2 to break it down to a 6-month interest rate. So we multiply the number of years by how many times we compound per year, and we divide the interest by the number of times we compound in a year. Those are the adjustments that we have to make when we're going through these different calculations. So again, this first video just serves as a brief introduction of sort of what we're going to be getting into. And in the next videos, what we'll do is start to walk through some of the examples of how to go about accounting for bonds given a couple of different scenarios.